5, 4, 3, 2, and 1. Hi guys, looks like we're ready to roll, and I want to welcome you to this event. I'm John Miller. I'm a CPA, and while if you're an entrepreneur or just somebody that's interested in taxes, you're welcome to listen in. We wanted to especially do something for the attorneys, CPAs, and enrolled agents, and any other tax professionals out there, so we can make you aware of what's happening in IRS audits today. There seems to be a lot of buzz in the news. I want to tell you what's happening specifically on the front line, because we do represent a lot of taxpayers in audits, usually returns that other people have done. So we're going to get started. And as you know, our current president wants to radically increase the number of IRS auditors out there. That's going to be pretty tough for a lot of people, because I've said all along, I don't mind you increasing the number of auditors, but let's also increase the training that we've got at the IRS. We have a real training deficit there. And I think I'd be spending my money on training first. Now, I will say this, on the IRS audit side, there seems to be a lot more training and education and knowledge of the tax laws. But I am concerned that on the collection side and in other areas of the business, there seems to be a real gap in the knowledge level of the employees. So it seems to me like we could do a lot in the education area at the IRS and get more bang for our buck through just training and education of the employees. But nonetheless, according to President Biden, we're going to start seeing a large number of increase in audits. And I want to tell you what we're seeing right now. So I've got several audits going right now. These are all returns that are done by other CPAs or tax professionals of some kind. I've even got an interesting situation that a tax attorney was involved in. But first and foremost, just completed an audit. It was a really interesting audit. Usually when I see an audit, right away I know exactly why they're getting audited, because somebody put something stupid on a tax return. And I hate to put it at such a base level, but you know, if I see a nice round number for miles, like on an automobile, you drove 36,000 miles on your automobile, I automatically think in my mind, and you don't think the IRS is not going to audit it, you just lob that one across the plate to them. We actually did see a case like that where a guy got audited. I think it was 32,000 even miles. So let me just tell you this. So let's picture this. The guy was driving around doing his business, you know, and he was legitimately driving in his business, but he magically stopped on 32,000. You think about that. The odds of that are 1 in 1,000, I think. Okay. So remember that even if you did magically stop on 36,000 business miles in your mileage log, it might be a good idea to trim it back a bit so that you just don't draw attention. But on this guy's audit, there was something really interesting. He owned an S corporation. And I'm just going to advance the slides. Hopefully you can see this a little bit, but he assigned the income from his insurance agency. So he is an agent for a major insurance carrier. And the carrier at the time that the returns were prepared, the carrier did not allow them to pay the commissions to the business, in this case, an S corporation. And so on his W-9, he listed himself as the payee, put in his social security number. So the 1099 that came out was listed to him. And of course, if you have a 1099 for business income, you're going to have to put it on a Schedule C. And so far, so good. So the payer paid the individual, the 1099s issued in the social security number. The trouble was, he had an S corporation. That's a separate taxable entity. And so in this case, the CPA put something like income assigned or income reported on XYZ corporation, EIN this. Now, a lot of people have done it. I've seen a lot of returns like that. The problem is the tax courts have all ruled against us in that area, guys. You can't assign income. And here's the other problem. The S corporation paid him a salary. Now, the salary wasn't sufficient. We're going to talk about that in a moment too. But at the end of the day, the S corporation fails. It's over, guys. And that was his first comment, the auditor's first comment to me, by the way. And the CPA represented the client through the audit, but wasn't really, I mean, I think he was doing the best job he could, but that had some ceiling to it. And he was really getting the client into more and more trouble as things were going on. Well, the client fired his CPA, hired us. We looked through it, talked with the auditor, and the first words out of the auditor's mouth were, well, the 1099 is issued to him personally. And then he goes and he assigns the income to the S Corp. And I said, yeah, I know the problem. Let me take a look at the file. Let me take a look at the facts. It just so happened. And here's the cool part, that for some reason, the guy had a management agreement with the S Corp where the S Corp paid or received fees from the Schedule C, the proprietorship, for work that the S Corp did. And it's not perfect. I'd rather the W-9 be issued to the S Corporation and their EIN, not the individual taxpayers. But in this case, I was able to show, and this was a contemporaneous document. We didn't go make up some management agreement between the proprietorship and the S Corporation. This was actually in existence. I don't know who had the brilliant idea to do it. Maybe it was a CPA, and I got to give him credit. He just didn't raise that in the audit, and the auditor didn't see the value in it. But in this case, it actually saved the taxpayer. Of course, I added a few other arguments around this, but at the end of the day, if you're assigning income from a Schedule C that comes in due to a 1099 that's issued in the taxpayer's individual name, and they're trying to report this income and claim the tax benefits on an S corporation, it's going to fail. There's no other way to look at it, guys. And even with the management agreement, I think you're a little bit at risk. But in this case, it saved the guy, and we were able to do a workaround and make things happen. Let's talk about another trend. This should be no surprise to some of us. I'm seeing cars, automobiles, sleds. Of course, they don't call them sleds in all parts of the country. They might call them snowmobiles, ATVs, UTVs, razors, any kind of vehicle, guys. First question that's going to pop up is it ordinary and necessary? And I had a case recently where the guy claimed a sled. Actually, this was the insurance agent's case. And of course, the auditor's like, why does he need a snowmobile? And why is that ordinary and necessary in his business? Well, as it turns out, he takes the sled into areas that are snowbound in the winter to inspect property so that it can be underwritten for insurance purposes. So that was perfect because now we've got necessary. And for a guy that's got to go into snowbound areas to do his job, to conduct his business, the necessary is going to be met. And I can make an argument for ordinary as well. And I did ask him, of course, what's the business use percentage of this? Are you using this sled, to go up to the, just go out and have fun with your buddies? And in his case, he said, no, it's got low miles. I'll show you. He says, I only use it for the insurance business. So in that case, I think the sled, in this case, worked. I've got another guy who's in the snowmobile business and takes people out snowmobiling because that is his business. He operates a business around snowmobiling. Ordinary, necessary. That means is it a sled, an ATV that has a business purpose? Is that business purpose ordinary and necessary? Then we can probably take the business use percentage. The other things with cars, sometimes you'll see excessive cars. We had for a guy out of the Southwest. We actually had an incredible outcome from that. He was assessed millions of dollars. We settled for $10,000. But one of the items that they did disallow was a very, very expensive luxury car. But that was largely because he couldn't substantiate the business use, especially when you own a trucking company and you're trying to claim, let's say it's a high-end Lamborghini. That's not what it was. But, in your trucking business, is the Lamborghini important for your trucking business? How is that necessary and ordinary? But, maybe there's a case where I'm open to listening and I want to listen to all the facts and circumstances. I'm certainly going to try to make the case under audit if there is a position. In this case, there wasn't. And so we let the very expensive luxury car go in this case but we fought hard on the things that we did think valid in the tax return. And it's obvious when you're throwing a luxury car into the mix, or an ATV or a sled, you just got to be asking the right questions. You got to make sure it's not going to flag it for an audit. It's one thing to be absolutely correct on a tax return. I talk about this with my look at it and say, is there anything in here that's going to flag it, going to cause questions? And if so, there are lots of tools that we can use to suppress or dissuade the IRS from auditing that return, like adding extra, statements or documentation to explain the facts. I'll never forget, years ago, I had an audit where we had a cancellation of indebtedness. I included a whole bunch of schedules showing the insolvency of the taxpayer, and giving them all kinds of data. The taxpayer did get selected for an audit, a field audit. They only had the questions around the cancellation of debt, income, and all the questions they asked, we actually had attached to the return. So it was everything I could do to control my desire to say, hey, why didn't you read the return? But I basically said in a polite way, guys, we attached that information to the tax return, but here's a copy for you. And we actually closed that case in about 2 weeks. So it was a pretty easy one. So I think adding documentation helps prevent it from getting an audit. Also, maybe just wording and just, taking it and making sure that there isn't anything that stands out, like the 32,000 even miles. Even if you had 32,000 even miles, they were all valid business miles. They're all in the mileage log. Is that something you really want to put on a tax return? It might be better to put 31,873 or something and just kill a few miles in this thing and forgo a little bit of the deduction. I'm not saying that you should always do that, but there are certain things that are clear audit flags. Another thing we've seen in a recent audit was title issues on a car. I get asked this question a lot. How should I title the vehicle? I use it in my S Corp, my C Corp, my partner, whatever you use it in. How should this car be titled? Ideally in the name of the entity. So if you're operating an S Corporation, ideally that car should be titled in the S Corp. The insurance should be in the S Corp's name. The loan should be in the S Corp's name. Everything should be in that S Corp. The reality is that's not always practical. And so in addition to titling, I would also have an accountable plan. And it's amazing how often no one talks about accountable plans and how important they are. Literally every S Corp we take on as a new client, that's our first question. Do you have an accountable plan? It's in our onboarding procedures. And if they don't have an accountable plan, we want to set that up for them, make sure that's in place. And an accountable plan isn't a very complex tax document, guys, or legal document. It basically says that employees, including shareholder employees, can be reimbursed for ordinary and necessary business expenses, including auto, including, at the IRS accepted rates, travel, meals, everything. You have to supply an expense report in a timely manner. At the end of the day, that's an accountable plan. And you want to make sure you have that, because on a recent audit, and it involved a car issue, and reimbursement for the car, the guy said, well, does he have an accountable plan? And I didn't know the answer to that, but I pretty strongly suspected he didn't. In a later conversation, he didn't. But remember, this was the C Corp this was the Schedule C proprietorship and the S Corp. And so where he didn't allow it on the S Corp, I actually got it claimed on the Schedule C because it was an auto used in the business. Sorry, guys. So, sometimes there's a workaround. It's not the best workaround, but the best insurance here is make sure you've got an accountable plan for all of your S Corps. And then finally, the most bulletproof, solid piece of substantiation on a car is a mileage log, even if it's titled in the business name, even if you think you're using it 100% for business. I guarantee you are not probably using it 100% for business. I even see the sheriff's cars parked at their home in my city. Just think about it. Make sure that there's a mileage log. When people go into an audit, I make sure they've had a mileage log. And if they don't, sometimes I've had them sit down, go through the calendar that they had at the time, because a lot of people keep calendars. And so if they knew they had to drive to Arizona from Utah or California, they did a MapQuest. They documented those miles so that they could grab whatever miles they had a record of and what the business purpose of that trip was. There are some great apps, by the way, for mileage logs. I think one is called Mile IQ. You can go to the Apple or Google Play Store or wherever and find a great app for mileage. But you're going to need to document the business use percentage. There's the actual method of deducting cars and the mileage method. But at the end of the day, both methods require you to document your business use percentage. And I've been asked straight across the desk, do you have the mileage log? And you always want to say, here you go. And in one case where the business owner had to document his mileage by going through his calendar, he actually found more miles. We explained everything fully to the auditor, and she actually allowed the additional miles, even though we gave her some other things. And in that case, we settled up the case for probably $1,000 where there were significant, just mistakes. But at the end of the day, we got a good result for the taxpayer because we were able to grab some additional deductions that hadn't been included in the returns. But I see a lot of mistakes, a lot of problems, a lot of challenges around cars and vehicles, particularly the unusual vehicles like sleds and ATVs. We have a razor in our business, by the way, but it has a plow. So it's actually snow removal equipment in the winter. It's only used for business. And sometimes we'll also take it out we're planning to do it on some of our live events using it, but it's only used for business, oddly enough. All right, let's talk about expense focus. I don't think this is going to be any surprise to you guys. In addition to cars and auto, one of the areas I see a lot that they focus on is the travel, the meals, and the entertainment. And the questions these guys are asking is, once again, is it ordinary and necessary? We know that's the standard. Did you have to go to Hawaii with your wife and kids? That was actually a deduction on a tax return that we carried through an audit. The guy went to Hawaii with his wife and his kids, deducted the whole cost. But at the end of the day, he was the only one required to travel to Hawaii. It was primarily for business, but he took his wife and kids along, and we had to disallow or remove the wife and kids from the deducted amount on his business return. Is it reasonable? We're not talking about, extravagant, incredible trips that you'd have to really stretch to get a business purpose out of. But, the more unreasonable it is, the more likely it is to flag an audit. I have a current audit going on right now where the guy suddenly went from not traveling much to traveling a lot to the tune of maybe $150,000 a year for business. And as it turns out, they were opening up a new line for their business. And it was just necessary for him to incur all the travel. So I don't think we're going to have any trouble with that one. It's just that it flagged it. And then another standard to think about is the trip primarily for business. And of course, we know as accountants that, based on the facts and circumstances and what we do, we can make it primarily for business. It doesn't mean it has to be 100% for business. It just means it has to be primarily for business. Those are all the standards and questions they're going to be asking as you're talking to the auditor. I don't think I have to comment on meals and entertainment. We all know that the substantiation requirements are elevated for those types of things. And of course, entertainment's no longer deductible, but we're still under audit years for entertainment. So hopefully when you're going into the audit or you're using us to represent you on the audit, you got to remember that somewhere on that receipt, it says who it's with, what the business purpose was, and then you're probably fine. But I think there's a lot of focus in that area. One of the things I think I still get a kick out of this because I teach a lot of continuing education. In fact, later what we're going to do is we're going to tell you we've got a partnership bootcamp coming up for tax professionals, primarily attorneys, CPAs, and enrolled agents. We'll try and put that in the description, a link to, you can go to privatetaxeducation.com and find out about our bootcamp. But at the end of the day, I think it's an incredible value to be able to generate partnership tax returns. Generally, those are high value returns with substantial fees in some cases and a great deal of complexity. So you'll be able to see that later on. But I teach a lot of the continuing education, and inevitably what I'm seeing a lot of is this question between contractors versus employees. And you got to know, guys, that some of the things I'm hearing about from people is that my CPA or my attorney told me that I should only have contractors because then I don't have to pay payroll taxes. And that isn't the decision. Whether you have to pay payroll taxes or not is to determine whether it's an employee or a contractor. Most of us know this. But the hilarious thing is, up where I live, we moved up near Jackson Hole, Wyoming, and Yellowstone Park in eastern Idaho. In a small town, you get a great view behind us. But the reality is that, they were kind of doing things the way, they thought they ought to be done, even though they weren't correct up here. So there were a lot of businesses paying people on a 1099, even though they were employees. So, for example, a guy came to me and he was a mechanic. He was wearing the shop's uniform. He had scheduled hours. He was using their tools. He had to request time off for vacations or doctor appointments or whatever. Any one of those factors kills the whole test of employees versus contractors. And most people think it's just a question of payroll taxes, but it's not. And big deal if it is, because if I pay somebody on a 1099, generally they're going to want more money because they're going to have to pay self-employment taxes. That's my experience. Second is, what are we talking about here, guys? 9-10% in payroll taxes for an employee. Even if you burden it with the workers' compensation, or in some states, labor and industries, or other payroll taxes, we're not talking a lot of money here, but we are talking about a lot of risk. Because let me tell you about the risk. I had a guy come to me about 7 years ago in the state of Washington, and he could not get a business license. He could not operate his illegally operating contractor company because a few years before, he had a contractor working for him. He wasn't willing to put him on payroll, so he made him this 1099. I don't want to call him an employee, but that's what some people call him, 1099 employee. But he was a contractor. He put him on as a contractor, but again, failed all the tests for being an employee. And on the first day, the guy jumped off a ladder, broke his ankle, ended up in the hospital. And Labor and Industries in the state of Washington paid about $250,000 in medical fees to help this guy recover medically. And all they did was turn around and hit the business owner with the $250,000 judgment. He lost 5 ways to Sunday on the contractor versus employee front. And so he not only owes it as a business, but he was assessed it personally. And his business was taken away from him. He was no longer allowed to operate a business in the state of Washington until he cleared up this workers' comp or L&I claim. And to support and feed his family, he had to go on. And so he just operated under the table. And unfortunately, that's a Class C felony, operating a business without, a license in the state of Washington. So it's really ugly, guys. We're not just talking about saving, 8, 9, 10% in payroll taxes. We're talking about the liability that comes with workers' compensation. We're talking about a lot of other things. I also had a case a couple of years ago. We helped a company acquire another company, start up. They wanted to make the case for being contractors. They were contract drivers, like truck drivers, only they're delivery drivers. In their industry, it was kind of standard procedure. I told them, now get this, we can make this totally legit from a federal tax perspective and truly make these contractors, but you're still at risk here. The guy wanted to take on that risk, so we did it that way because that was kind of the usual and customary method of doing it in his industry. And within a year, he was audited by Unemployment Security of the state of Utah, and he lost the case for them being contractors. They are employees for unemployment insurance purposes, even though they were contractors for everything else. And there's been a lot of legal changes and court cases, a lot of them originating out of the state of California, that's making it harder and harder and harder to operate as a 1099 contractor for somebody performing businesses for your business. So I get the idea. We contract with other businesses like for marketing or graphics design or something. That's okay. They're operating a legitimate business. They're in the business of doing that. But if the person you're having work for you is working solely for you and you're their sole source of income, and then we kill some of these tests, just recognize you're going to have a problem. Your clients are going to have a problem with them not being classified as an employee. And you might think you're saving 8, 9, 10% in payroll taxes, but you're way out there on exposure for other areas like workers' compensation. By far and away, one of the biggest areas I'm seeing lately with S corporations, and I believe the audits of S corps will increase modestly. It's still pretty low compared to a Schedule C taxpayer, and I think rightfully so. But one of the things is reasonable compensation. So our shareholder employees, so in my business, my wife and I both own our businesses 50-50, just by nature of it being a community property state, but we're partners in everything anyways. But she does nothing in our business with Private Tax Solutions, even though she's a 50% shareholder. We don't have to pay her a reasonable comp because she doesn't even work for the business. But I obviously have to be paid reasonable compensation. And I will tell you, I'm weary of hearing over and over, because I'm seeing the audits that come through, that there's rules of thumb, like at this income, you should only have to pay this much in reasonable comp to your shareholder employees, or a third or 20% or half of the income in the business is all that you're going to have to pay. So that if the business is earning $150,000 net income, you should be okay with a third of that, 50,000 is reasonable comp. And then it's going to take that net income obviously down to 100. There are no rules of thumb. There are no percentage tests that work, guys. It's been proven over and over in the court. And a recent audit that I had, the S Corp made about $300,000, and the reasonable comp on the officer compensation line was $10,000 even. And I explained to him, I know exactly why you got audited. This is one of the reasons. And he said, yeah, I took it to a buddy of mine in Washington State who's a CPA, and he told me the same thing. It's our job, guys, to recognize that reasonable compensation is an issue. We use a company called RC Reports to determine what the reasonable compensation is for all our shareholder employees in every single S Corp. It's bulletproof, it's audit proof. And then the $10,000 guy in reasonable compensation, I will just tell you that the initial determination on the audit, and it hadn't gone to an NOD yet, but the proposed adjustment showed that his reasonable comp was going to go from $10,000 to $150,000. They were going to take all of his net income and make it reasonable comp. That's most often the case. Most often, they're going to pick up all of the net income, not a reasonable comp, but all of the net income. And in this case, that was about $150,000, multiple years. So, you multiply that by all the payroll taxes, 941 and 940, and you can guess he had a pretty sizable tax bill. We ran him through a reasonable comp analysis for each of the years. Then I discussed it with the auditor, and I said, listen, I'd really like to settle this at our level, you and me, but I'll appeal this and I will win, because this is bulletproof. I'll win through the tax court and I'll litigate this. And I showed him that the reasonable compensation for this individual in his business, and he was only working 50% of the time, was about $29,000. So the trouble was the $10,000 got it flagged, but the $29,000 was reasonable compensation. And we successfully agreed on that with the IRS, and we didn't actually even have to appeal. So it was perfect. And of course, net income is not the standard either for an S Corp. And I only say that because that's generally what the IRS is going to argue. They're going to say, well, it's the net income. You should have just paid all of that since you didn't do it correctly. And that's the wrong answer too. And we need to have the strength to push back gently, of course, with the IRS, but influence them that that's not the right standard, and that's not going to work through the tax court either. All right, another area, receipts, records, and substantiation. These are all problem areas on audits. I see them over and over and over. So first of all, on records, accounting records, we require all our clients to come in to use our firm to use QuickBooks Online, QBO, or they have their own accounting system internally if they're a bigger business. but at the end of the day, I don't want somebody that's doing it in spreadsheets or, you know, writing it down and saying this much for auto, this much for my mobile phone, and this, maybe for an easy return. But let's face it, if they're going to be in business for any length of time, we really have the obligation to make sure they're using a decent accounting product. It's going to ensure their long-term viability, help them to be productive, help them to be profitable, and it's going to weather an audit or exam a lot better. So I recommend QBO or desktop. It just happens to be in our firm, we won't accept desktop because I don't like the back and forth with the files. And I think QBO has gotten quite a bit better over the years. And I just like the flexibility of me and the client can be on QBO, QuickBooks Online at the same time, looking at the same books, making the same changes. And it's super easy for us to start the tax return in late January after we've gotten the 1099s all out for the taxpayer. We talked about mileage logs. Can't emphasize that enough. Any car used in the business, you better have a mileage log. And then we scan all our receipts in our business. And this is how I teach our clients. Just scan the receipt. I give my receipts to my office manager. She knows exactly what to do. She scans it. We always save it in a folder, that's under receipts, and then by year. So we've got a 2020, 2019, 2018 and back file or folders for each of our businesses. And then in 2020, for example, if we bought something from Staples today, we would name the file 2021-6-29 Staples, save it as a PDF, and it's done. I don't recommend doing anything super organized with the physical receipt at that point. I tell people just shove it in a little Pendaflex folder or whatever. And if you actually need the physical copy, that's fine. But I've never had a revenue agent in probably the last 7 years want to see a paper receipt. Heck, most of the time the print is faded within a few weeks anyways. So, just get in the habit and get your clients in the habit, teach them to just scan it, save it in an organized way. And I like the way we do it because it's super easy. And finally, just things like documenting meals and making sure you're documenting the business purpose. A lot of this stuff sounds maybe, mundane and routine and, kind of like stuff we should know. But the reality is, guys, I'm seeing this stuff over and over. So much so that this audit we just concluded, the guy had been assessed about, I think, $130,000. And in the preliminary adjustments, and I don't think that included penalties or anything, disallowed the car, cranked up his reasonable compensation, disallowed a bunch of expenses for lack of substantiation, and then at the end of the day, killed his S corp because of the 1099 issue. We were able to kind of sort it out and bring reason and ultimately reduce the assessments by about $60,000. But you don't want to be having the conversation with your client if you haven't thought through it. And while I'm saying that, guys, make sure your clients understand you're just positioning them so that if and when they do get examined, they're ready, they're bulletproof, it's good to go. And I'm like you guys, sometimes that's not the case with my clients. So I'm working on progress, not perfection. It's not uncommon for somebody to have misplaced some things or not tracked some stuff, but we're moving them in the right direction. I deal with a lot of past due tax returns because we're doing a lot of tax resolution work. And so somebody comes to me with 5-6 years of unfiled returns, it's not going to be perfect, but we want it to be good. Because if they get examined, I want to make sure we've got a really, really strong prospect for getting through this thing and not worrying about what's going to happen to us. And by the way, what's going to happen to us is if we do it wrong, we're going to be looking at paid preparer penalties. And I will tell you, in the case of this one case where the guy put down 10,000 of reasonable comp, there were lots and lots of mistakes and errors, and it was really a reckless tax return, borderline fraudulent, that the preparer had done. And in talking to the auditor said, we're well aware of this CPA, and implied that they were going after all of the returns that he had done. Just imagine that, getting all your clients audited. I do know of one other CPA that happened to, where they yanked in a lot and started assessing a lot of additional taxes, fines, and penalties. But let's not forget, not just the risk of not doing the right job for our clients, we also risk paid preparer penalties and substantial understatement penalties. And these taxpayers are going to be looking to you when you make significant mistakes, even though it's their mistakes sometimes. And so sometimes it's not always our mistakes. We're careful to tell them, particularly on past due returns, hey, we're working off the information we have. There's, it's going to be as good as we can get it within reasonableness. But at the end of the day, you still risk that for lack of simultaneous records, for lack of documentation, sometimes you're going to face some additional taxes. But we've been pretty successful under exam and working with our clients to get a decent product out, even if it is 6 years late. The other thing to keep in mind, guys, is this is not the end game. Once the audit adjustments are issued, the NOD is issued, you've got 90 days to challenge that. You've got an appeal. You always get one appeal. And then you miss that, you get hit with the NOD and the 90-day letter. You're going to have to file a tax court petition. I probably filed 3 or 4 this year with our law firm that we use for these things. We have taken some difficult cases through tax court and done very well, but usually we never make it to tax court because we're almost 100% of the time settling beforehand. And so, do the best you can up to the point you have to appeal. Then on appeal, do the best you can to close out the rest of the matters. And if there's too much left, then you may have to file a tax court petition. My experience most of the time is by the time that somebody gets me involved, they've already hit them with the NOD, and the assessment is going to happen unless they file a tax court petition. And that's when we have to get involved and really do a lot of fast and fancy footwork and make sure that people, are protected to the degree possible. I have found that the U.S. attorneys that work in the tax court for the IRS are pretty reasonable human beings. I like working with them a lot. They seem to have a level head about themselves and are very skilled and trained and knowledgeable and decent people to work with, so that even if you get a bad case, but you got decent facts and a reasonable prospect, sometimes you can work with these guys. But at the end of the day, bad facts, bad case, you're not going to be able to do much with. So anyways, as I mentioned, give me a call if we can help you. I did want to, just with the time remaining, comment on the fact that we are planning this Partnership Bootcamp in August. We're pretty excited about it. It's going to be 100% virtual. We're going to do it right here from the studio for 3 days. We're offering 24 hours of continuing professional education. It'll be largely focused on partnership taxation, which I find tend to have pretty generous fees, high value. So we're not just giving you continuing education. We're giving you really a business tool that's going to generate revenue for you. So check out our website at privatetaxeducation.com. Make sure you're registering if that's an area of interest to you. I think it's a fantastic area to be involved with partnership tax and then the taxation of the individual partners. Any questions we ought to address, Malcolm or Corey, that have come up in our time? Okay. Well, guys, it's been great to be with you. We're going to do this for a few weeks to kind of build to our Partnership Bootcamp class. Hope we see you for that class, and we'll be back in a week. Thanks a lot. See ya.